Good evening once again. Please shall we pray? Father, in the name of Jesus, we thank you so much once again. Thank you so much for the divine mercies and grace you have shined upon us this day. We pray, O Lord, that you come and be with us as you said you will be with us. You are always with us and we say we are grateful. We thank you once again for all you have been doing for us. We thank you for our past month this day. Oh Lord, come and be with us. Come and be with us. Come and be with us as you always have been. This day we commit our lesson into your hands. As without you, the builder built in vain. We are building, O Lord, and we need you on this ride. On the D-Day, we know we shall surely smile. In Jesus' name we pray with thanksgiving. Amen.
Amen.
So we are going to deal with one of the areas that are controversial, okay? A lot of people do not like these areas, but they are areas that we can easily deal with and make our marks from. Okay, these areas pop up most often, and they mostly pop up as theory instead of calculations. But however, there are some calculations under this one. One thing, before we start looking at trust, you must understand that trusts are accounted for like any other entity. Okay, so it means that the the way you compute company taxes, you are going to compute so for trust. But the best way to compute for trust is when you start and then you just do not include the allowable deductions in there, right? So when we talk about a trust, what is a trust? A trust is just an arrangement. I hope when I speak, you can hear me, or my voice is down. I just want
Yes, we can hear you.
to be clear, or my voice is down.
It's clear.
Yeah, okay.
It's clear.
So a trust means an arrangement under which a trustee holds asset. Now, this is under the concept of what we call stewardship. You've heard of the stewardship theory, right? So we are saying that under a trust relationship, there's a stewardship relationship where a person, okay, so we have the trustor, or let's say the beneficiary, right, of the trustor, who is supposed to what? Receive something, okay? So let's say that the beneficiary or the truster, okay, gives his assets to a trustee who holds it in trust, okay, for this beneficiary. And on the day of maturity, it must what? Be paid, or that investment return must be paid to that beneficiary. Now, the relationship that is created is what we call trust. Okay, so a trust is actually a relationship, a stewardship relationship, right? An arrangement under which a trustee holds an asset. Okay. And then people know that when it comes to companies, it is easier for the Commissioner General to spot tax planning. So now they use trusts to do their tax planning. You see a trust who owes another trust, who owes another trust, and bought a company, and then bought a private partnership, and then bought a conglomerate, and created a conduit entity. So it is difficult to trace their tax residence. Okay, this is usually the issue that is faced with trust. Okay, so you must really understand what trust implies. Is that okay? So we have seen the meaning of trust. So it means that if I have party A here, right, who gives us asset to party B, party B now invests in, let's say, a plan, right? A plan asset, for instance. Now, this one is an investment, right? When this grows, party B receives it in bulk, and party B now distributes. Let's say there's C here, there's D here, right? All these are beneficiaries. Party B will now distribute to each of these beneficiaries. Now, this is what we call a trust relationship. A trust is actually a relationship. Is that okay? So we have the beneficiary here. So there are cases where the trustor is the same as the beneficiary, and there are issues where the trustor is different from the beneficiary, meaning that the one who gave his assets in trust, okay, those assets or those investments from the asset are now going to be paid to his daughter, his son, or any other person who now becomes a beneficiary under that trust relationship. Maybe, assuming it was your estate, we are now distributing those estates to someone else. I hope that is okay. Well understood? Did you understand what a trust means?
Yes, sir.
Yeah. So we are saying that in this relationship, there are some tax implications. We have to try and then what? Understand the tax implications. So first of all, who is a trustee? A trustee is an individual, or a trustee can also be a body corporate who holds assets in fiduciary capacity for the benefit of identifiable persons or for some object permitted by law, and whether or not the assets are held alone or jointly with other individuals or body corporate, or the individual or body corporate is appointed or constituted trustee by personal act, by will, by order or declaration of a court, or by operation of the law. Okay, and includes an executor, administrator, tutor or curator, a liquidator, a receiver, a trustee in bankruptcy, or judicial manager, a person having the administration or control of assets subject to usufruct, fidecommissum, or other limited interest, a person who manages the affairs of an incapacitated individual, and an arrangement, a person who manages assets under a private foundation or other similar arrangement. So all these things are various circumstances which the Income Tax Act under Section 133 holds as a trustee. It means that so far as you have either an individual or a body corporate that holds an asset under a trust relationship, that person is a trustee. It doesn't matter whether it is a company which is collapsing and that person takes the role of an executor, an administrator, a liquidator, receiver, a trustee in bankruptcy, or a judicial manager, right? Or a person who has administration or control of your assets under law, or for a commission, are you getting it? Or somebody who manages the assets of an incapacitated individual, like an insane person or an infant, a child, right? A minor, let's say that, a minor, somebody who is less than 18 years of age. When he has liabilities, it is his parent or somebody in what representative capacity who handles it for him, okay? So if you have a private foundation or any other similar arrangement, the person who manages it for you is also known as a trustee. Okay, so when we talk about trustee, the person who holds your assets in trust is a trustee. In a company, a trustee is the director, right? So for trust, the director is what we call the trustee, right? Who manages the affairs of the what? The beneficiary or the shareholder. Understood? Is that clear? Did we get the relationship?
Sure.
Okay. Now, when we visit Section 56 of the Income Tax Act, it gives us the principle of taxation for trust. Now, just like companies, a trust is taxed separately from the beneficiaries of the trust. So with the diagram we saw earlier, we saw that what? When we have A and we have what? B, you remember this relationship, right? This whole thing becomes a corporate entity. Okay, so this relationship now becomes an entity, which is the trust. And the law is saying that this trust is taxed separately from A, who gave his assets to B, right? So give me their names. What is the name given to A? And what is the name given to B? A gives his assets to B to manage for him.
Beneficiary and trustee.
A becomes the beneficiary, right? And B becomes what? The trustee. Okay. But the law is saying that what? Just like if you are looking at companies, then this is the shareholder, and this is what? The director, right? And there's always divorce of ownership and control. So we are saying that this relationship that has been created, which is the trust, is now an entity. And this entity shall be taxed separately from the beneficiary. Does that make sense? Does that make sense?
Yes.
Means that this guy has a separate liability from the trust itself. Okay, so where a group of persons are trustees for more than one trust, the income of each trust shall be calculated separately. So let's say B here has another trust with C. Okay, has another trust with C, has another trust with what? D, right? What we are saying here is that no matter what we do, we can't say that all the trusts are trusts that B is working in, so we should add the income separately. We should add all the incomes together. We don't do that. Each of them is a separate relationship and a separate what entity. So we shall calculate taxes for them what? Separately. What concept is this? What do we call this under our act?
Fencing.
Ring fencing. So you realize that under every section that we look at, there's ring fencing. Whether you like it or not, there'll always be ring fencing, right? So far as you have activities that are different from other activities, we deem it as ring fencing. So far as one person has various activities, so far as it does not belong to the same income, you have to calculate them separately. And ring fencing is the segregation of what? Business income into separate streams, right? For tax, legal, or regulatory what? Purposes. Is that clear?
Yes, sir.
So we have seen the rules of trust. Then this is the thing that we used to do trust, right? It is taxed separately from the beneficiaries, where if you see trustees and you don't understand, just replace it with directors. So it's like a trust is taxed separately from the shareholders of the trust, who are the beneficiaries. And where a group of persons are directors for more than one trust, the income of each trust shall be calculated separately. It makes sense, right? So if you are a director for more than one company, then the income of each company shall be calculated separately. Does it make sense? Makes sense, right?
Yes.
Because they are separate companies. So we are saying that when it comes to incapacitated individuals, how did I define incapacitated individuals when we're looking at the definition of a trust? Who did I say an incapacitated individual was? Who is an incapacitated individual? Yes. Who is an incapacitated individual? Somebody who does not have the capacity to contract, right? So if we say you are incapacitated, basically we are looking at what? A minor. Okay, we are looking at a minor. We are looking at what do we call it? Apart from minors, we are also looking at insane persons or somebody who cannot carry out a contract, right? Who cannot contract. Okay, these people or these persons are known as incapacitated individuals. But mostly here, we are talking about somebody who cannot carry out transactions. So somebody is managing his affairs for him. Okay, so the trust of an incapacitated individual, mostly a minor, shall not be taxed separately from that individual. So when it comes to incapacitated individuals, we treat the trust as if it was that of what? An individual's trust. Do you understand? So it shall not be taxed separately from that individual, and it shall not be treated as an entity just like any other trust, right? So the normal trust we saw first, we can tax them as entities, and thus we tax them at 25%. But the trust of an individual, an incapacitated individual, mostly a minor, will be treated using the graduated rate, right? So a person who calculates the tax liability of the trust of an incapacitated individual shall treat the trust as though it was an individual and hence tax the person using the graduated rate. Does that make sense? Does that make sense?
Yes, sir.
So that is it. Now, just like companies, right? Trust may also have some assets, they may have some liabilities, they may have some expenses. I get it. All these things, what we do is that just like companies, right? Any asset that is owned or a liability that is owned by a trust or a trustee. I told you if you want to read this and understand it better, you can replace trust company and replace trustee with director, and it makes sense. See, if I read it this way, an asset owned or a liability owned by a company or a director of that company is an asset or liability of that company. Does that make sense now?
Yes.
Yes, because it tells you that so far as you own an asset in the company's name, even if you are the one using it, it is still the company's asset. True or false?
True.
So if, let's say, you join us as a director and we give you a house, does it still not belong to the company?
Yes.
It does, right? Now, a person shall treat an amount derived and an expenditure incurred by a trust or a trustee, okay, as an amount derived or an expenditure incurred by the trust, and that applies whether or not the amount is derived or incurred on behalf of another person, and whether or not any other person is entitled to that amount of income. What we are saying here is that assuming a director, okay, or a beneficiary derives an expense on behalf of the company. Let's say you pay the suppliers, right, on behalf of the company. Is this still not the company's expense? That is what leads to something like director's fees or director's loan on their account. So let's say that I took my own money and I used it to pay off a company supplier. I will not say it's my money, right? It's an expenditure incurred on behalf of the company. True or false?
True.
The same thing happens to trust. It's still the same. And when I receive money from a customer on behalf of the company, even if I use it, it is still the company's money. Whether or not I'm entitled to that amount or not, it is still belonging to that trust. True or false?
True.
True. So that is what it says about asset liabilities, amounts received and expenses, right? Now we are coming to the taxation of the beneficiaries of a trust. We have looked at taxing, a trust is taxed separately from the beneficiary. So we have looked at how to tax the trust at 25%. And when it is the trust of an individual, an incapacitated individual, how do we tax it? How do we tax the trust of an incapacitated? We said, how do we tax it?
Using graduated rate.
Using the graduated rate, right? That is what we said. So how then do we tax the beneficiaries? Now, just like we saw for the, what? Was it insurance? You remember proceeds for insurance? If it's distributed by resident insurance company, it's exempt. Do you remember? But if it is distributed by a non-resident insurance company, it is included in calculating your income. The same thing happens here. Now, when you receive a distribution from a resident trust, it's exempt from taxation if that distribution is in the hands of the beneficiary. Okay, meaning that at the entity level, it is taxed. By the hands of the beneficiary, it is what? It is exempt. This is what it means. It means that assuming we had what? Profits before tax, right? Assuming you have profit before tax in this trust, which was 100,000, right? This one will be taxed at what? When I say profit before tax, I mean chargeable income, right? This one will be taxed at what? 25% also, which is 25,000. Do you get it? So assuming that we are distributing everything to our beneficiaries, right? So this one is what? Our profit after tax. Profit after tax, which is what? 75,000 also, okay? So this will be distributed as follows. Okay, this will be distributed as follows. So distributed as follows. So assuming we are distributing the whole 75,000, I get it, to the trustee. Now, this is in the books of the company. Now, when it comes to the hands of the beneficiary, right? We are saying that if this is a resident trust, then the income received, which is how much? The 75,000 will be what? Exempt from tax. Does that make sense? But if it is what? A non-resident trust, if this were to be a non-resident trust, then that means the 75,000 that was received will be added to this guy's income and taxed accordingly, right? This is not dividends, it's receipt from a trust. We add it to his assessable income and tax it. Makes sense? That's why it's what? A distribution of a non-resident trust is included in calculating the income of a beneficiary of that trust. Okay, so that is it. So the next thing is what? After you've looked at distributions, you also have to look at realization. Okay, so you know realization is everywhere. So we are saying that a gain on the disposal of the interest of a beneficiary in a trust is to be included in the income of the beneficiary. So look at something here. How? Assuming you only invested, you are the trust, you are the beneficiary, and you invested 100,000 in this trust, right? But you were leaving the trust, and there was somebody who was interested in your stake. So you sold that stake to that person for 120,000. What has happened? Have you had a gain or you have had a loss?
Gain of 20,000.
You have a gain of 20,000. Now that gain of 20,000, what happens is that this gain, the losses added to your income. So this one does not matter whether it's a resident trust or it's a non-resident trust, right? So far as you make a gain by transferring your stake in a trust, it shall be taxed. It shall be taxed using, if you're an individual, then the graduated rate. If it's from the perspective of an entity, remember an entity can also be a beneficiary, okay? Then it will be taxed using the appropriate rates application. Makes sense? Makes sense?
Yes, sir.
Okay. So that was about trust. I hope it wasn't anything difficult. Let's see if we can deal with some questions. So it says what? Let's see. Asona is run as a trust for Mami Kupua, who is a Ghanaian based in the USA. Okay. Now Asona is based in the USA and represents a lot of people in trust arrangements. Okay. So it's Ascona. Ascona is a trust, right? Meaning this is the trust, the entity, which is run for Mami Kukwa. Who is Mami Kukwa? Is it an entity or is it an individual?
Individual.
Okay. But Mami Kukwa is a Ghanaian based in the USA. We've seen it. And Ascona is based in the USA. So is it a resident or non-resident trust?
Non-resident.
Okay, and represent a lot of people in trust arrangements. Okay, under the arrangement, Mami Kukwa, who is currently living in the USA, has acquired a transporter vehicle for Ascona to use it for the benefit of her two children. Okay, Yaya Mensah and Nana Yao Mensah, right? Who are both resident in Ghana. Now, in January 2019, Ascona made a distribution to Yaya Mensah and what? Nana Yao Mensah in Ghana via Western Union money transfer. Okay. Mami Kukwa has asked you, a young tax expert in Ghana, to advise on the taxability or otherwise of the above transaction in Ghana. Advice on whether a distribution by non-resident trust, such as Ascona, is taxable and how. Yes, this question is for you. We just learned this. What did we learn? What did we learn?
You said distribution from a resident trust is exempt, but distribution from a non-resident trust, we add it to our normal income and charge, subject to tax.
So how are we going to tax the distribution by non-resident trust, such as Ascona? Now, when you're answering tax questions, right, you don't just jump straight, right? Look at how you start. You can start by at least talking about because of the word taxable, you should tell us how trusts are taxed in the first place, right? Before you now jump to the rule for taxing the trust. Does that make sense? So I'd go for it to say under section 56. Even if you don't remember the section, you say under relevant sections of the Income Tax Act, a trust is taxed separately from the beneficiaries of the trust. When a trust makes a distribution, the following shall be considered before it is considered taxable or otherwise. 1. A distribution by resident trust to its resident beneficiaries is exempt from tax. On the other hand, when the distribution is done by a non-resident trust to its resident beneficiaries, the said distribution shall be subject to tax in Ghana. Are you getting it? You can go for it to say, and therefore added to the income of those beneficiaries and tax, right? So if the beneficiary is an individual, tax using the graduated rate. If it's an entity, tax using the appropriate corporate rate, right? On the basis of the above. So you see, you tell us what the law says before you now go in to tell us what, on the basis of the above or from the case, the distribution by Ascona is taxable in the hands of Yaya Mensah and Nanaya Mensah because it is a distribution by what? A non-resident trust. I hope this is not bad.
Very good.
Okay. Makes sense. So usually, if it is a non-resident trust, that means that there are a lot of what? There are a lot of what? International corporate issues which may come up, right? Because it's non-resident. And how would you know this is non-resident? Look at the nature of the operation. I hope that is okay. Fine. Now, this is a question that let's try and see if we can do something about it. Compute the chargeable income and tax payable for the trust for the 2022 year of assessment and outline the general tax rules on trust institutions and what trust beneficiaries. This one, I think this is, if I was doing, this is the first one I would do, right? Because this one is easier. So yes, what are the general tax rules on trust and trust beneficiaries? Yes,
Hello.
quick.
Yeah. Hi.
Background.
Papa, me was Zoom.
So what are the general tax rules on trust institutions and trust beneficiaries? Yes, the question is for you. We just learned this. Give me that one before we start the question itself. The general tax rules on trusts and then beneficiaries. Yes, we just learned this.
The trust is taxed separately from the beneficiary.
That's 1. 2. So the B part, tax rules, right, for trusts. So I will say 1, a trust is what? in accordance with section 56. A trust is what? Taxed separately, not so, from the beneficiaries of the trust, right? Beneficiaries of the trust too, where a trustee is what? Or where a person is a trustee. Let me use it that way. Where a person is trustee of multiple trusts, right? Of multiple trusts. The income and taxes are computed for those trusts what? Separately. True or false? Ring fencing. Is that all we learned? The
Yes.
trust is taxed as an entity, not so. It's an entity, therefore subject to tax at what?
25%.
At 25%. So if it is a trust of an incapacitated individual, right? That's what we learned. Also, incapacitated individual shall be treated as a trust of what? As a trust of an individual, right? An
Yes.
individual, and thus taxed using what?
Graduated rate.
Graduated rate, right? As specified in the first schedule. So once you are done with this one, you get your first format. The second format comes from the taxation of what? Taxation of what? Beneficiaries. Look at the nature of the question, right? And this is how far trust goes. They can't ask you anything beyond this, right? The next one says what? General tax rules on trust and trust beneficiary. So taxation of beneficiaries, we know that what? When it's a distribution by what?
Resident of
A resident trust is exempt in the hands of the resident beneficiary, right? If it's a non-resident trust, it's taxable and then shall be added to the income of the beneficiary. So if the beneficiary is an entity, it shall be taxed at 25%. If it's an individual, it shall be taxed using the graduated rate, right? Then you come to gain on disposal. So when you dispose of your stake in your trust, right, and you make a gain, you shall be added to your income and taxed accordingly, right? So you say this, you get your 8 marks. I hope this is not difficult. Yes, so trust is one of the easiest areas, but always when it comes, students leave it blank. I don't know why they leave it blank. Is it that they haven't learned about trust or they don't know? I can't tell. I don't really know. But I hope that is okay. So we have dealt with the B part. Now we go and see what we have. We have to compute the chargeable income and tax payable for the trust. Okay, so let's see. Fenty Trust Limited is a non-resident company who is acting as the trustee for 4 resident Ghanaians, of whom each has 22.5 share in the trust. Okay, so these 4 resident Ghanaians who have 22.5% share, what name will we give to them? Who are they?
Close company. Trust.
No, look at it carefully.
Okay.
As the trustee for 4 resident Ghanaians, whom each has 22% share in the trust. I'm just asking, people who have share in a trust, what is their name?
Beneficiary.
Yes, just the beneficiary.
Yeah, beneficiary.
You're thinking too far. You're thinking too far. It's not a company. Okay, sometimes you just need to simmer down and understand. Okay, now, this trust was set up on the instruction of Mr. Carl Odogo before he died, okay? Now, Mr. Carl Odogo was a businessman with interest in real estate, transportation, and numerous natural resources. Now, the Board of Trustees decided to continue in the above businesses and others. As part of the trust deed, the Board of Trustees were made to make donations for good causes and discretionary payments to the beneficiaries where appropriate, okay? So this was part of the trust arrangement, okay? That is there, okay? Now, in the year 2022, the following transactions were made. We have total rental income. This is the income of the trust, right? So I told you that when they hold assets for you, they can use those assets to invest and make income and appropriate expenses, right? So the principles of allowable expenses and income still works there, right? So we have total rental income of 9375, admin expenses of the trust, allowable or disallowable?
Allowable.
Allowable. A friend of Kalodogo contributed 600,000 to the trust by way of donation. Income of the trust?
Yes.
Okay. Interest received on the bank account of the trust was 350 gross. Is it income of the trust or investment income?
Investment income.
You are tax people, so you should understand. Okay. The trust received a total amount of 1,240 from transport operations. It can't be income of the trust, right? Or it is?
Yes.
That's what I'm asking you. You are the student, so you are the one writing exam. We have learned the principle, so now you have to apply. That's what I'm asking. And I'm hearing the same voices. What about the rest? You are not saying anything. Total depreciation computed and treated using generally accepted accounting principle. 104, allowed or disallowed? Depreciation, allow or disallow?
Disallowed.
Okay. Remuneration and fees of the trustees. That's director's fees, right? Allow or disallow? Yeah, it is. External audit
Allowed.
charge 45,000 and it has been paid. Allow or disallow?
Allowed.
Now, donations were made to the following persons. Ghana Heart Foundation. We received a receipt from Ghana Health Service. Allow or disallow?
Allowed.
Allow. Donations were worthwhile costs. Remember, Kumasi Children's Home. We made a receipt. We received from Social Welfare Department, right? We have a receipt to cover it, so it's also allowed. XYZ political party.
Disallowed.
Disallowed.
It's not a worthwhile cost, but we still received a receipt from them. Then funeral of a cousin of one of the members of the governing board of the trustees. Also
Disallowed.
disallowed, right? It's not
Disallowed.
allowable expense. The GRA has granted capital allowance of 81,250 for the trust, and discretionary payment of 265 for each beneficiary was made during the year. So this is a distribution, right? So they said we should get a chargeable income of the trust. Okay, so all you have to do is just gather all their income less the allowable expenses. That is all. Do you understand? Then for discretionary payment, you have to take it out because those ones will be taxed separately. Remember, income of a beneficiary is taxed separately from the trust. So as it was part of that income, you take out those discretionary payments and tax them separately in the hands of the beneficiaries, right? But then you tax it at what? 25%. So you see, you have rental income, we have gifts that they received, you take their interest received. Though this is investment income, remember, trust also do investment, right? So you take these ones, add all of them, and now less allowable expenses. What some people do is that they compute the whole net profit, then they now add back, which is a waste of time, right? Just like you did for insurance, add all the incomes, less all the allowable expenses, right? Take out any discretionary payments, tax it. When you finish, do you get it? When you finish, then you less any withholding tax credits that you have, then you are done. So when it comes here, it's only the allowable expenses you bring. It means that depreciation and the ones which are disallowed will not bring it at all. So it is either you exclude the what? The disallowable expenses, right? You just exclude them because they are excluded and domestic expenditure. But where you went and then they gave you the net profit of the trust already, you can just take the net profit and then add back. Do you understand? Make sense?
Sure.
So it's that easy. It's just like any other company. So sometimes they may give you the net profit of the trust. That means you start from there and add back. Do you understand? So this is how we deal with trusts. Okay, so anything that was not allowed, we didn't see depreciation there. We didn't see the donation to the what? The XYZ, right? We didn't see the the political party, and then the funeral of the trustee's son. Not so. So the same way, then because there was interest received, which was gross, you see, that means you've already added it to your income. So you can take a credit for it, right? At 8%, which is a tax credit. And that's 28,000. Makes sense. Any question on trusts? Any question on trusts?
So,
Mhm.
if, knowing that trust is like a company, if the trust also invest in another trust, like the illustration you did,
Mhm.
and also more than this 25%, are we going to treat dividend from that second trust as the same way we did for the companies?
That one was under company. So for trusts, it is a matter of debate because that section was on taxation of shareholders of a company, not trustees of a trust. Are you okay?
Yes, sir.
Okay, sure. So let's see. Randy Kumsin, who hails from Cape Coast in the Central Region, died in January 2021 and left his businesses and estates with trustees who happen to be non-residents. Now, Randy Kumsin has two children, Araba Kumsin and Kwamina Kumsin, and these two children were made the beneficiaries, and each of them is entitled to 1/3 of the net distributable income of the trust, with the rest for administrative expenses. The terms of the trust deed provided for discretionary payments to the beneficiaries and donations towards worthwhile causes. Now, during the year 2021, discretionary payment. What is the treatment of discretionary payments? I taught you right now. How do we treat discretionary payments? Oh, how do we treat the previous one? The discretionary payment we saw in the previous question. How? Oh, I'm asking a question. Oh. Everybody's quiet. Jessica, do you want to say something? How did we treat the discretionary payment from our previous question?
Oh, no.
But you were all here. How do we treat it? Wow. Okay.
Sir, excellent.
Yeah, William.
Yeah, I joined late, but what I heard is that you said it's like you charge it separately, you tax it separately or something.
You deduct it.
Okay.
You deduct it from the profits and then you charge it separately, right?
Separate.
That's how it is treated. Thank you. Now, they said gross profit before discretionary payments and other expenses below. Now, one thing you should understand is that discretionary payments are part of the trust agreement, the deed. We call it trust deed. They are part. So just like other expenses, they are also allowable expenses because under the deed, this is the agreement we have made, right? You take it out, but then it shall be taxed separately in the hands of the one receiving it because the benefit to that person. Do you understand? That is it. Now we had gross profit of 3.5 million. The following expenses. So you just take your gross profit 3.5. And let's look at what? The expenses that we have. Donations, trust fees and remuneration, admin and other expenses and depreciation, right? So we know that these are the expenses that we will take out from this. But then we have to look at which ones are allowed and which ones are disallowed the same way. So donations were made to the following persons and institutions. Ghana Scholarship Secretariat, we received a receipt from GES. Allow or disallow? Allow or disallow?
Allowed.
Allow.
Allowed.
Worthwhile cause. A political party for campaign.
Disallowed.
Disallowed. Funeral of the mothers of two members of the governing board of the trustees. Disallowed.
Disallowed.
Two children's home. We had a receipt from the social welfare department. Allowed.
Allowed.
Okay. COVID-19 fund. We had a receipt from the Ministry of Finance. Allow, right? The chief or Oman Henny of Cape Coast, disallow. Also,
Disallowed.
okay. Then the admin and other expenses. We have legal fees for litigation on one of the buildings of the late Randy Kumsin. Allow, right? Because
Allowed.
anytime, I told you that anytime you have legal fees, which are incurred for defending title or right to your assets, is allowed, right? So this will be allowed. Accounting and audit services, allowed, right? Penalty for late payment of income tax, disallowed. Also, how about entertainment? Didn't have further information. So I would disallow, right? If we had further information about what kind of entertainment that was, maybe end of year party or something, then fine. But there was no further information, so I'll disallow. Legal fees for collection of overdue rent, I would allow, right? Because they are running a real estate company, and then the legal fees for collection of something that is from your customer. Okay, you sued the person, you're receivable, so it's allowed. Motor running expenses allowed.
Allowed.
Bank
charges
charges allowed.
allowed.
Okay, and it says, so compute the income tax payable by the trustees. Very simple. You just take your gross profit, you less your allowable deductions. So we add donations, the one to the scholarship secretariat or Seuss Children Home, and then what? COVID-19. When you come to admin expenses, the legal fees we allow, the accounting service, the legal fees for the rent due, the motor running expenses, the what? The charges, right? Then you come to the allocation, which are the discretionary payments, and they were receiving 300,000 each, right? So you see, always you have expenses before discretionary payments. So once you get those ones, right, then you have what? The trustees and their fees, which are like directors' fees. Those ones will be taxed in the hands of the directors, right? But the allowable expenses, you allow them, get your adjusted profit, less your other allowable deductions like capital allowance, get your chargeable income and tax at 25%, right? So you see, you don't know
But
how to treat discretionary fees or discretionary.
also,
Yes.
please, sorry to ask. My network keeps going on and off. I wanted to ask the discretionary payments. What are we supposed to do to?
That's what I said. There are allocations under the trust deed, so they are allowable deductions, but they'll be taxed in the hands of the trustees separately because they are still distributions from the trust. Do you understand?
Yes, please.
It's
But I
like
don't understand why the previous question that we saw, we multiplied it by.
in the previous question too, we deducted it.
Yeah, but we multiplied it by 4.
No, we didn't multiply by.
Okay, thank you.
Let's see. Discretionary payments of 265,000. Yeah. Quarterly. I said quarterly. There were four, what do we call it?
Okay, thank you.
Four, hey, why is the word not coming? 4 beneficiaries.
Okay, thank you.
Somebody says, say, please light on B part of section 129. Emmanuel, you said I should throw more light on the B part of section 129. Is that what you're saying?
Yes, sir. Yes, sir.
Scrolling there. It says what? It says, despite the definition of a company, each of the following is treated as a company for the purposes of this act. Now, a partnership in which at least 20 of the partners have limited liability for the debts of the partnership are not considered as a partnership, but rather a company. In the same way, if you have a trust with at least 20 beneficiaries whose entitlements to participate in the income or capital of the trust are divided into units, just like shares, are you getting it? Such entitlements are determined by the number of units owned, just like shares. Emmanuel, are you okay? So we are saying that when you have a trust with at least 20 beneficiaries and the entitlements come in the form of what? Units like shares, then we shall what? We shall treat the entitlements like the way we treat shareholders. Okay, just like shares, we allocate it based on the number of units you have. So if we are giving per unit, then you get times the number of units you have. It's just like that. So distributions will now be based on the number of units, just like we treat other shareholders in companies. That is why that section is headed as companies. Do you understand?
Okay.
Clear?
Thank you, sir. Clear.
Okay. So any question on trust? Are we okay? Jessica, are you okay with the discretionary payments now?
Yes, please.
Okay. Okay, so that is fine. So let's look at specialized entities. And the first specialized entity I will teach you how to tax is what we call a retirement fund. Okay, so just like trusts, how do we tax retirement funds? Okay, this one is rare. You hardly see it in exam, but who knows? It's part of your syllabus. It has been examined once or twice, but let's look at it and even look at some calculations around it. Okay, now a retirement fund is a special account that allows you to save money for your retirement. That is that simple. Now the accounts are designed to accept contributions, invest those contributions to grow your money, and ultimately provide you with income when you retire. This one we know already, don't we? Don't we? Don't we? Meboa. Everybody knows what a retirement fund is. Isn't it not a retirement fund?
It is.
Yes. So that is a retirement fund. Now, what are the types of retirement funds in Ghana? So there are two main categories of retirement funds in Ghana based on their approval status. Now, we have what we call approved retirement funds. Now, these are retirement funds that have been officially recognized and approved by the commissioner. Okay, like likely the commissioner of the GRE or any other commissioner for any division of tax, right? Through a written notice. Okay, so there are likely specific requirements of a fund that must be considered approved. So this could involve investment regulations, the management structure, or transparency standards. Okay, so there are some likely tax advantages associated with approved retirement funds. And the provided passage provides that tax exemptions for contributions and potentially tax-free withdrawals from resident approved funds. Okay, so we'll go there when we get down there, right? Then we have unapproved retirement funds. Now, these are any retirement funds that are not officially approved by the commission. Okay, so you have some retirement funds. If you send to GRA, they will not approve it. It's not something that they'll consider. So they may be what? Fewer regulations or oversight for these funds. So it's important to exercise caution when considering them. What's the tax treatment or tax advantages or disadvantages there? Now, contributions to unapproved funds might not be tax exempt, and withdrawals must be subject to taxation, right? So the thing is that if it is approved, it's exempt from tax. And also when it is included in the taxation of income of an individual or your employees, it's exempt from tax. We'll come and look at that. But if it's unapproved retirement fund, everything about it is taxable. Okay, so contributions to a retirement fund are mostly exempt, but when it is an unapproved retirement fund, it becomes taxable. Don't worry, we'll come there, right? Now, when you are choosing a retirement fund, this is not tax related, but then when you are choosing a retirement fund, okay, approved retirement funds are the preferred option, right? But to make the best decision, you have to consider factors like your risk tolerance, right? How comfortable are you with your investment potentially losing value, the fees associated with the funds, and the investment options that are offered by the funds? Like, do they align with your risk tolerance and your retirement goals? Okay, so let's look at section 94. Generally, retirement funds are taxed on the income they earn from investments, like interest or dividends. Okay, so here we are talking about the entity itself, not the contributions you make to SNET. We are talking about taxing an entity like SNET itself. Do you understand what I mean? So if you, the entity itself, you're a retirement fund, how do we tax you? Okay. If you, the entity itself, you're a retirement fund, how then do we tax you? So this is similar to how any business would be taxed on its profit, right? But remember that retirement funds are taxed on the income they earn on investment. We only tax them on investment income, okay? It means that when you make tax contributions to your retirement funds, the good news is that they are not taxed. So contributions to retirement funds are exempt. Essentially, the money you put in isn't considered income from the retirement fund itself. I hope it's understood. I like to break things down for you. Now, 2, tax on payment from retirement fund. Now, the money a retirement fund pays you when you retire, which is a retirement payment, can also be deducted from the retirement fund's income. Wow. What does that mean? It means that contributions that you make into the fund are not taxed, and the receipts you receive, that's your benefit you receive from it, are not also considered taxed. So they are not also treated as deductions, because if the receipts into the fund are not treated as income, then the deductions from the fund should also be treated as deductions. Does that make sense? Does that make sense?
Sure.
So these payments are not considered when calculating the value of the fund's assets or liabilities as well. Okay, because if the income that came in is not taxed, then its corresponding deductions should also be taxed. That's the rule. Now, how do we tax monies received from retirement funds? Now, when you receive retirement payments, generally, if it's a resident fund, the money you got is not tax exempt. When it's a non-resident retirement fund or funds received outside Ghana, then any amount received that's more than what you contributed is considered income and may be taxed. So you see one principle. It's like everywhere, if it comes from a resident entity, it's mostly exempt, right? But if it comes from a non-resident entity, it's mostly taxed. Have you noticed? We saw that proceeds from insurance companies, proceeds from what? Insurance companies were deemed what? Taxed. Do you remember? If it's a resident insurance company, if they were exempt, and if it's a non-resident insurance company, it's taxed. The same way, when we came to trust, we saw that when you receive what? Distributions from a resident trust, they are exempt from tax in the hands of the beneficiary, right? The same way, we saw that if it's a non-resident trust, it is taxed. When you come to retirement funds too, if you receive money from a Ghanaian retirement fund, okay, or a resident fund, it is exempt. That's why your income from SNIT is not taxable, right? 2, when, assuming you receive your retirement fund from a foreign fund, okay, a foreign retirement fund, then it shall be added to your income and taxed. Understood? So this is all about what? The retirement fund. Okay, so putting money in your retirement fund gets you a tax break. You don't pay tax on that money. The money earned by the retirement fund itself might be taxed, right? When you retire, the money you get from a Ghanaian retirement tax is tax-free, and there might be taxes on money from foreign retirement funds. So this is all about retirement funds. So when you are computing income for retirement funds, there are some things that you need to understand, right? So they are regular business. Okay, they pay taxes on the overall profit, which is calculated by subtracting their deductible expenses from their total income. But remember, I told you that deductible income, their deductible expenses should not include what? I mentioned some things that should not be part of their deductible expenses. What shouldn't be part of their expenses? You have forgotten. I mentioned that the retirement distributions should not be part, the benefit you pay out should not be part, though it's a deduction from the fund. When the contributions came, you didn't tax it, right? You didn't include it in your income. So why is it that the distributions outside the fund, you are included it in your income? We don't do that, right? Okay. Now, they get a special treatment. Contributions made by individuals to the fund are not considered taxable income for the fund itself. Are we okay? So it essentially reduces the fund's taxable revenue. If it was included there, you have to take it out, like how you treat what? Non-taxable income. Then tax deductible expenses. So in its regular businesses, right, they can deduct certain expenses like salaries, rent, and some business costs, depreciation, capital allowance, and all that, right, from their income to arrive at their taxable profit. But payments they make to retirees, that's the retirement payments, are not considered deductible expenses. This means that these payments do not reduce the fund's taxable income. Okay, so mostly they are taxed on their investment income, less expenses, just like how we treat life insurance businesses. Is that okay? So what's the impact on assets and liabilities? Now, regular businesses, okay, that do retirement fund businesses, the cost of acquiring assets and liabilities is factored into their tax calculations through capital allowance, right? But if you are looking at approved pension funds, the retirement payments are not treated as a cost when calculating the value of your assets and liabilities. So this likely simplifies their tax calculations. Okay, so the whole thing is that retirement income and retirement payments are not included in income or expenses, neither in the cost of assets and liabilities, right? So it is only the investment side that we consider. So let's see how this works in practice. I'm just going to give you a simple question. However, this may be long. So we have the following information which relates to Prof's pension funds for the year ending 2023, right? So let's see. Retirement contributions. Can we add it? Can we include this in income based on what we learned? Can we include this in income?
No.
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 Okay. It says investment income. Can we include in income?
Yes.
Yes. Retirement payments. Can we include in expenses?
No.
No. Penalties and fines allowed?
It's
No.
allowed.
Disallowed. Management expenses allowed, right? Taxes paid on installments disallowed.
It's allowed.
Dividend paid
Mm.
disallowed.
It's allowed.
Depreciation
It's allowed.
disallowed, right? So for pension funds, the only thing is that we are going to allow capital allowance, right? So for pension funds, just like any other company, the same way, we'll start with what? Profit before tax, right? So let's get their tax. Profit before tax. Profit before tax also 14,800, right? Let's look at okay, 48. Then we are going to less what? Non-taxable income, right? So which income was non-taxable?
Retirement.
Yes, we learned that
Contribution.
retirement contributions cannot be included in income, right? How much was the retirement contribution? That was
12 million.
12,000, right? So that means you are left with what, 2,800, not so. Okay. So now we add back what? Disallowed deductions, also, or disallowed expenses. So disallowed expenses, what do we have? We have retirement payments, also. We learned under section 90.95 that retirement payments are not allowable deductions. So the retirement payment of 2 million, also, will be added back. Then we add what? Penalties and fines, also. Penalty, how much? 2,800 added back. Then we have tax paid. Tax paid 1.2 million, add back. Dividend. Dividend 2,800, also add back. Then depreciation, also. Depreciation was 2 million, add back. So when we add all, what do we get? When we add all back, so we have 2,000 plus 2,800 plus 1,200 plus 2,800 plus 2,000, right? And that was what? 10,800. So 10,800 plus 2,800. That is 13,600, right? Which becomes our adjusted what? Profit. So adjusted profit, we now less allowable deductions like capital allowance, right? What's the capital allowance agreed with GRA? That was 2,000. So 13,600 minus 2,000. That gives us 11,600. So 11,600, we'll tax the retirement fund at what? We tax it at 25%, not so. That gives us what? That gives us 2,900. Okay. So are we okay with taxation of trusts and retirement funds? Any question? So assuming this, okay, let me ask you. Assuming this trust was not an approved retirement fund, then what will happen? So let's just assume this was not an approved retirement fund. So what will happen? Oh, we learned it all. Don't make me shy. If it is not an approved pension fund or an approved retirement fund, then what would we have done?
Whether the tax authority will accept this adjustment.
Yes, and also if that is the case, then the retirement contributions will be taxable.
My contribution.
Okay, that means if this was a non-approved fund, that means these retirement contributions will be taxed. So that means we would accept this 12 million. but the retirement payments will not be allowed because it's not approved. Do you understand? Do you get it? Do you all get it?
Yes, sir.
Any
Sir,
questions so far? Any questions so far?
okay, sir.
Yes, boss.
A question. It's more like a general question. So the retirement contribution, when the retirement fund receives it, does it go to their balance sheet? Because now I know we are not going to treat it as income.
No, for tax purposes, we are not concerned about how it is treated. But then the thing is that in its proper balance sheet, like for accounting purposes, yes, there are funds held in trust for other people. They are liabilities.
I'm asking this because
No,
I'm thinking.
tax is not concerned about what you have on your balance sheet. Remember, we
Oh,
read
okay.
that in terms of assets and liabilities, they are not considered.
Because I'm thinking that by all means, the retirement contribution, the retirement payment is by all means going to be more than the contribution. And I think that you can only compensate for the difference by when you invest the contribution. So meaning
And
part
that's
of
why I was saying that when I got to the distribution to
okay.
the fund, look at what it says. We read it. We read it. That one is only when it comes to distribution. See,
Okay.
it says what? Resident funds are exempt, right? The money is taxed. But then if it's not resident, any amount you receive, that is more than what you contributed, is now considered income and may be taxed. You get it now?
Okay, thank you. Yeah. Yeah. Okay.
These things are deep. Oh. I went too deep, but I hope it's worth it. You
Yeah.
okay? Any questions so far before we go to the taxation of charities? You have to look at the taxation of charitable organizations. So all these ones that we are looking, if you look at it, you see that the tax treatments are almost similar. Have you noticed? The trust, the retirement funds, do they look similar? Do they look similar? They do, right?
Yes.
Yes. And this is what I want you to have, because these things pop up in your exam frequently. Okay, now they notice a lot of students, when it comes to company tax, they are on top. When it comes to the taxation of partnership, sole proprietors, they are on top. But when it comes to these areas that are rather easy, students have no way around it. They don't know because they don't look at that part, because most people just focus on the taxation of companies, taxation of partnership, taxation of individuals, right? But these are areas too. These are also entities which exist. So you need to make sure you know them like the back of your hand. Is that okay? Shall we proceed? Now, the income accruing to or derived by a charitable organization is exempt from what? From tax. And what word I should have used there was that the income derived or accrued to an approved charitable organization is exempt from tax. An approved charitable organization. An approved charitable organization is exempt from tax. So this exemption does not apply to the business income of that charitable organization. It means that how is the income of a charitable organization different from the business income of a charitable organization? So a charitable organization has incomes which it was set up to collect. For instance, if I take a church, then they are set up to, by all means, collect tithes, offerings, and also honorariums, harvest, those kind of incomes will be exempt. But if they are doing business like selling hymn books, selling water, selling anointing oil, selling these things, they constitute the business income of a charitable organization. Does that make sense? Things you sell, business income, things that accrue to you directly as part of your constitution or generally as part of your business are considered exempt from tax. That's the general rule. Make sense?
Yes.
Are you sure you get it?
Yeah.
Okay. So the minister which is the Minister of Finance. If you see Minister in Income Tax, is the Minister of Finance. Now, the Minister of Finance may also, by an LI, a legislative instrument, make regulations for effective implementation of these exemptions for these charitable organizations. Is that okay? Now, let's look at the approval of a charitable organization. I told you that it should be what? Income accruing to or derived by what? An approved charitable organization. So if you have an approved charitable organization, then its income is exempt. Now, what is an approved charitable organization? Before the commissioner will consider you as a charitable organization, you should be approved before you can enjoy those exemptions. And how do you get approved? The commissioner may approve a charitable organization for the purpose of the act. Okay, so the Commissioner General, before approving an entity, should ensure that, so these are the conditions. Anytime you have to talk about charitable organizations, you have to consider these conditions before you can say that, okay, this organization is actually a charitable organization. Is that okay? So the entity should have been established to operate as a charitable institution, which is of public nature. So first of all, you should have been set up to be a charitable institution of public nature. 2, you should have been set up as a religious institution of a public nature or a body of persons formed for the purpose of promoting social or sporting activities. So first of all, do you fall into these categories? 1, are you a charitable institution of a public nature? That means you serve things of public interest. Are you a religious institution of public interest as well? You are not formed just for the benefit of some few people, some few elites or select people. Are you a body of persons that is formed for the purpose of promoting social or sporting activities? Do you fall into this category? That's the first criteria. The second criteria is that apart from being this, you should have a written constitution that promotes you from engaging in party political activity or using your platform to engage in party politics or performing functions other than those which are taken by what? Entities which are charitable organizations, or any function you perform confers a private benefit other than in pursuit of your original activities. What does that mean? So, assuming you exist as a church, but then you rent out canopies, or you do something outside the normal course of your business that fetches you income, meaning it is conferring a private benefit to you. You bring a political party to do campaign. It is a private benefit to you. These things would mean that you have breached the criteria. So all 2 criteria must be met for you to be deemed as what? A charitable organization which has been approved. If this criteria is not met, the commissioner would what? Not give you approval. And even if these criteria are met, sometimes the commissioner can revoke the approval he gave you before. Okay, so revocation of an approval. Now, the Commissioner General may, for a good cause or for the contravention of the above, revoke an approval granted to an organization as a charitable organization. So it means that for charities, they are exempt from tax so far as they are approved. And then their business income is what? It's taxable, right? Okay, and the minister may also make what? An LI to make regulations for effective implementation for the above exemption, right? So these are the rules for charities. Make sense? Does that make sense? Does that make sense? So let's go to clubs and trade associations. Now, when it comes to clubs, small clubs, right? Or clubs that are different from normal NGOs. We looked at the taxation of NGOs, which are charities. Now we are looking at clubs and trade associations, right? Now, the income accruing to or derived by a club, a trade association, or a similar institution is also exempt from tax. The rules are the same. So if you know one, you know all of them. So where the income of a club, a trade association, or similar institution from its business for a year of assessment is to be ascertained, the person doing the calculation shall include the income, I get in the income, any entrance fee. So if you have entrance fees into a club, exempt from tax, subscriptions, other amounts derived from members of the club, trade association, or similar institution are exempt. So the exemption does not apply to the business income of the club, the trade association, or similar institution. So when you have a club that runs a bar to make income or rent out canopies, water, does other sort of sales, right, to help the members or for the welfare of the club, they are business income. They are not the normal income of the club. These ones shall be subject to tax, right? But the normal thing that is in their constitution, I get it, shall not be considered. Also, the same principles that we saw above, if the club uses their platform to promote political activity, the commission may revoke the approval still, right? Then we come to the last one, which is building society. So the income of a statutory building society or a registered building society or a friendly society is exempt from tax in the year of assessment if only individuals are eligible members of that society, and thus they make contributions to the society in the form of subscriptions. Okay. Now, the organization does not engage in party political activities or support any political party or use its platform to engage in party politics. And the commission has given a ruling that the entity complies with the above. Okay. Then this building society or friendly society's income is exempt. But however, business income of these entities are considered taxable. There's still the same ruling. You see, the rules are the same. So the commissioner may revoke a ruling or refuse to give a ruling on exemption to a building or friendly society. So these are the rules on charities, clubs, and societies. I get it, as well as building and friendly societies and trade associations, right? These rules are the same. Their income is exempt so far as it's not business income, and they shouldn't use their platform to do political activities or engage in political activities, right? And the commissioner will give approval or may revoke an approval already granted. So these are the rules. So the commission may also amend a ruling on terms or conditions that he considers appropriate. Clear? So would we want to take some questions under exempt entities? I hope everybody's okay with exempt entities now. So let me ask you, what are the rules pertaining to the taxation of retirement funds? You see, I'm taking you back. Yes, who try? How do we tax retirement funds in Ghana? How do we tax retirement funds in Ghana? Yes?
Payments received from non-resident retirement fund is taxed.
Is that okay? On the tax principles, in terms of contributions and retirement pay, investment income, you have to talk about approved and unapproved retirement funds. So when we say the taxation, it should cover all these things. Yes, we will try. We'll try. We'll try. Taxation of retirement funds. Hey. We just learned it some few minutes ago. I intentionally decided to ask about that one. Yes, taxation of retirement funds. How do we tax retirement funds?
The contributions to retirement fund is also not taxed.
Okay. What about retirement payments? Not treated as allowable deductions. The only incomes that are considered are what? Investment income. Also, less other expenses. These are some of the things I want to say. And these ones that I'm talking about should be an approved retirement fund. If it is not, then the contributions will still be taxable, right? These are the rules. So let's take a question for the exempt entities. It says, present a report to the chairman of Dominion Gospel Church Council to explain the tax implications on the various incomes of the church, including allowances paid to the staff, including the clergy and the laity, and the exemption of the payment of VAT. Ignore penalties for non-compliance. Now, it says what? The Dominion Gospel Church, meaning this is a church, right, is a registered company limited by guarantee under the Companies Act, and the council of the church under the chairmanship of the head pastor has approached you as a tax practitioner for advice on issues pertaining to the payment of taxes by the church. Since the council wants to be tax compliant and a good corporate institution in all its activities, in consultation with the secretary of the council, you realize that the issue is in respect of payment of taxes on income of the church, including the payment of allowances to staff, both the clergy and the laity. He further informs you that sources of income of the church are from offertory, tithes, and donations, which are used for payment of allowances to the staff, one, and then charitable what, programs in the catchment areas of their operations, right? The charitable programs include building a preparatory school, construction of boreholes to provide water for the community, right? They look like charitable activities. But further inquiries on these charitable programs reveal that they charge fees for the use of those facilities. Charging fees for the use of these facilities now changes the nature of this charitable institute, these charitable activities into what? Business income. True or false?
True.
True.
True. And we said that the business income of a charitable organization is what?
Taxable.
Taxable. Okay. So they said the church claims it's meant for maintenance of the facilities, but it's still income charge. Now, a visit to the school to obtain further information on the operation shows that the school shall be classified as a commercial venture. So classifying the school as a commercial venture is indeed telling us that what? They are running a business, right? So you realize a lot of materials are purchased during the construction and maintenance of these projects. And the secretary believes the church should be exempted from VAT. Why should the church be exempted from VAT? VAT has no exemption regarding religious activities. Also, so how do you approach this, right? They say write a report. So all you have to do is still talk about what? The rules that we learned, okay? Always the thing is provide us the authority, the rules in law. You provide us the rules, you talk about the rules, then you say, okay, from the entity given this and this, okay? Always when you are answering question as a tax person, always give us the rules per the tax law. Once you finish giving us the rules per the tax law, then you say, from the case, this and this and this is what I expect. Is that okay? Is that okay? So let's see. The church was incorporated as a company limited by guarantee. It cannot be assumed that it is carrying on business for the purpose of making profit, right? Under Section 97, the church is required to register its activities with the nearest GRA office. And the income accruing to or derived from what? Their normal operations, which is offertory, tithe, and donation, will be exempted from payment of tax, provided that they meet the conditions for approval, right? Remember that before you can enjoy those exemptions by the commissioner, you should have gotten the what? The necessary requirement, right? That you are properly registered to function as a religious body or charitable organization and your public nature. I remember, you have been approved by the commissioner. You have a written institution that prohibits you from engaging in party politics or supporting a political activity or using your platform to engage in party politics or anything that confers a private benefit other than in pursuit of your objectives. We looked at this, right? But however, the income derived from the preparatory school is a business enterprise and is subject to corporate tax. And the income from the borehole water is exempt from VAT, right? That one will be subject to tax, but exempt from VAT. Why? Because supply of water is an exempt supply. As long as it is not treated and bottled for sale, but the income itself is subject to corporate tax. But when it comes to VAT, it's exempt. The church cannot be exempted from VAT on the materials purchased because the church is the final consumer of the goods. And income on all the employees will still be subject to payee, meaning that it is only the corporate income of churches or charitable organizations which are exempt from tax. But like withholding taxes or payment to your staff will still withhold and pay your pay as you earn tax. And the church will be expected to withhold tax on goods and services at the appropriate rate and paid to the GRA, right? So the same rules that we learned is mostly the approval that you look out for. But you can go for it to say that, however, once the commissioner sees that they are not meeting these criteria again, the commission may revoke any approval that has been given to them. We looked at this earlier on, didn't we? Didn't we?
We did.
Okay, so let's look at Bubandushe. Bubandushe is a non-governmental organization located in Accra with operational area in the northern regions of Ghana. The NGO buys rice from a supermarket in Accra and transports it to the northern regions for distribution to widows and orphans. Okay, its main source of funding is from a benefactor who is based in the Netherlands. who has been supporting the project since its inception. In support of its operations, it engaged chartered accountants from ICA as employees. Their role is basically to organize training programs for government institutions on budget preparation using advanced financial models for a fee, for a fee, right? This additional source of income equally supports the operations of the NGO. GRA has written to the NGO to regularize its operations with it. For the management has written to you. Okay, with it for tax purposes. The management of the NGO has argued that it is exempt from tax on its income. The management has written to you for you to offer what professional help on the matter. Determine whether the NGO is required under the laws to pay tax, and if yes, what type of taxes. On what basis are the NGOs liable to tax or exempt? The question is for you. Yes, we just learned this. Yes. Nobody is saying anything. We just learned rules. I have taught you one. Apply the same thing to this one. Everybody is quiet. Yeah, somebody was saying something. The person didn't continue again.
Said the NGO will pay tax on the rice that is bought from the market.
So a buys, look at it. What is the main activity of the NGO? To buy rice from the supermarket and transport it and distribute it from orphans and widows. This one, is it subject to tax or is exempt from tax?
Exempt.
This is the main activity of the NGO, right? And so it is approved by GRA. How would it get approved by GRA? How would this NGO get approved by GRA? They should what? They should be set up as an NGO of public, a charitable organization of public nature, or a religious institution of public nature, right? Or an institution that supports what? That supports social activities or sports promotion. Is that not so? And two, they should have a constitution that prohibits them from what? Any party political activity, supporting party political activity, or using their platform to support party politics before their income is exempt from tax. If they have met that criteria, then the rice that they buy and transport it to the widows and distribution, are you getting it? All these activities are exempt from tax, right? But then they organize training programs for a fee, making it the business income of the charitable organization, right? And I told you business income of charitable organization is taxable. And also the amount of money it pays to its employees, we shall withhold and pay on it. True or false? True. True. This is all you have to say. And you get your 8 marks, right? These things are not difficult too. You see, in tax, you have to be confident in your answers. You know, but sometimes the way you present your answers is the reason why you don't get it. Because you write short answers, like, oh, the entity will do that. No, start telling us, the law says this. Remember, I keep telling you something, that anytime you're answering a case, right? P, point. What is the point you want to talk about? What is the explanation? When I say explanation in terms of this, I mean, what does the law say, right? What does the law say, right? You talk about what the law says, then you now apply it, right? So point, explanation, evidence, or point, explanation, and application, right? So how does this apply to the case at hand? Therefore, since the law says this, it seems that this entity should now write to seek approval from the commissioner. It should have a written constitution that prohibits it from what? Party political activity and anything that confers a private benefit on them, right? If not, the commissioner may revoke the approval. Therefore, the income from their normal activities are exempt, and no, the fees that are paid or are received shall be taxed because they constitute what? Business income of the charitable organization, and any income that is paid to the employees will be subject to payee. You get the idea? So you say this, you get your full mark, you go. Makes sense? Does that make sense?
Yes, sir.
Okay. So we have Kankoka, which is registered with the Register of Companies as an NGO, has income accruing to 30 million, also in its 2018 year of assessment. Now, after breaking down the income, we see that they receive support from a benefactor based in Germany. Tax or not tax? They run a transport.
Not taxed.
They run a transport business, 10 million.
Taxed.
Government afforestation project, they disburse 10 million.
Not taxed.
So we have to tell them why this will be taxed or this will not be taxed, right? So determine the tax payable, if any, Kankoka, by Kankoka, and comment on your answer and state any relevant assumptions. So introduction, an NGO is a charitable organization that is exempt from tax on its NGO activities. We said this, when an exempt entity engages in business activities, the business activity shall be subject to tax. We know this already. So income from the benefactor of 10 million. Following the above, the support from the benefactor based in Ghana is not a business activity. After all, NGOs run their activities based on funds from benefactors and like-minded persons. So this is not a business activity, right? Okay, transport business income of the 10 million. Transport business is income from business for which Kankoka shall be subject to tax. Therefore, the income of 10 million from the transport business shall be subject to tax using the marginal tax rate of 25%. What about income from government afforestation? The funds from government afforestation is income that is meant for the dedicated purpose. So it is therefore exempt from tax in the hands of Kankoka. So it is only the income from transport that will be subject to tax at 25%. And the assumption is that income of 10 million has taken into account all costs associated with the transport business, right? Then you get your marks. So this was it for taxation of charities, exempt entities, trusts, and retirement funds, right? So if you have any questions, you can ask me. And the questions, this is how far they can bring you. There's no difficult question again. It's just the provisions that they will ask you, right? And maybe apply it a bit to a question. That is. So if you have any questions, I'm open. If not, that brings us to the end of our session today.